The squeeze, I think, has only just started. Now, I wouldn't claim to know how this is going to progress minute by minute or day by day, but it's clear to me that silver has still a lot of upside because it's turned into a giffen good, one where a rising price basically doesn't produce supply. If anything, it encourages demand. It does the reverse of what, the charts that we've all been shown do, sort of rising demand gets capped by price. Price, the function of price basically is to balance supply and demand. So you get the increase in supply at the higher prices. That's not going to happen, and it's not happening now.
The silver market is exhibiting behavior that fundamentally contradicts how commodities are supposed to respond to rising prices. Under normal conditions, higher prices incentivize producers to increase supply and encourage holders to release inventory. That balancing mechanism is no longer functioning. Instead, silver is now displaying characteristics associated with strategic goods, materials whose rising prices do not unlock supply, but instead intensify demand. This is not a theoretical observation. Recent developments across exchange-traded products, vault inventories, and delivery mechanisms at the LBMA and COMEX are confirming that silver is no longer responding to price signals in a conventional way. What makes this moment especially significant is that these signals are emerging simultaneously across Western and Eastern markets. The paper price continues to suggest abundance, yet the physical market increasingly reflects scarcity. ETF-held metal is functionally unavailable, exchange inventories are under stress, and industrial buyers are no longer behaving like speculative participants. They are acting as if future availability is at risk. According to Alasdair Macleod, these dynamics are not isolated to silver alone. They are part of a broader monetary transition that is steadily undermining the credibility of fiat pricing structures, one in which China and the Shanghai Futures ecosystem are positioned to play a decisive role. In the discussion ahead, Macleod connects these developments to deeper structural forces shaping the silver market, from exchange delivery stress and ETF ownership concentration to industrial stockpiling and the quiet re-engineering of global trade flows. He also examines why recent volatility should not be mistaken for a reversal, but rather understood as friction within a system struggling to suppress an emerging price reality. If you find value in this type of macro-driven market analysis, please like this video, subscribe to the channel, and turn on the notifications bell. Your support means the world to us.
Will these margin requirements actually amount to anything, or are these more of a speed bump? What do you make of this volatility in silver?
I think a speed bump is probably a reasonable description. Bear in mind that the shorts for their mark-to-market year end will want to see silver as low as possible. So I think there's a bit of motivation there. Let's put it that way. Mm-hmm. But we were chatting before you pressed the record button, and as I said, and you checked it out. This is right. There's still backwardations. Mm-hmm. And if anything, this morning, the backwardations are greater than they have been in the last couple of days between London spot, where the price is higher than on COMEX. This is a market which just cannot deliver the physical. The squeeze is not so much on COMEX, but it's more in London, where I have absolutely no doubt industrial users of silver are basically buying forward contracts and taking delivery, and there is not the liquidity there. I mean, various other people have sort of assessed the amount of free silver, as it were, but they can't sort of get it quite right because you've got, the bulk of the silver in the London vaulting system is actually ETF owned. So that is not liquid. There are ways in which you can access it if you're an authorized participant and all the rest of it, but for all intents and purposes, it is not liquid. There's something like 150 odd million ounces in excess of that. But an awful lot of that is in firm hands already. Mm-hmm. So the liquidity is, if one said it was virtually zero, I don't think you'd be far off the mark. And this is the problem. The problem is in London. It's an interesting thing. I ran the bank participation report off, the December one, a couple of days ago, because there was some I think it was an AI bot, which came up with this sort of wonderful thing about how the US banks were in trouble. They were terribly short, da-da-da-da-da. But actually, if you look at just at paper, the US banks are actually long of silver on COMEX. And but if you look at the foreign banks, or what they call non-US banks, they're the ones who are short. One assumes that they would be long of paper in London. But the problem is that even if they're long of paper in London, they're being effectively stood for delivery, if you like, by industrial buyers who come into the market and buy a forward contract and then want the real stuff. So the squeeze is actually, I think, very, very tight and difficult. And the problem is that, everybody in industry realizes now that, if they're in the business of making photovoltaic cells, electronic vehicles, defense industry, et cetera, they need silver and they need to get it damn quick. Otherwise, they're not going to have any manufacturing material. So we have a situation, I think, where the price gets driven up by this sort of demand. And it's a one-way ticket because there's no industrial user who sort of says, well, I got a little excess stuff here. I can maybe trade it out, sell a bit into the market, take a profit and buy it back cheaper. Or I can hedge it. No, they're not there anymore. Those guys basically realize what's going on. And I think one of the things that's interesting about the timing of this very, very sharp volatility is that, of course, it occurs at a time when any respectable industrial user is on holiday.
Yeah.
So, he's still digesting his Christmas pudding and looking forward to, well, if it's Scotsman, Hogmanay and too much whiskey. So the timing from the swap's point of view, we've got a year-end problem coming up. Like my bonuses depend on me making profits or being able to show that I make profits, and my mark to market doesn't kill those profits. Yeah, they love to bash it down. So that's what's going on. I think it's as simple as that. I think there is a broader question as to what China is actually doing. I mean, it is interesting because China is introducing really from next week officially a new licensing, export licensing regime. And it's not stopping silver going out. It's just tightening up on the export regime. And I think it's giving China greater control, if you like, over its over domestic stocks in the wider sense, not just China's own stocks. And I believe they've got a lot of stock which they've stored effectively, because you're talking about the second largest silver miner, but also the largest refiner by far. And bear in mind, it's not just imported silver doré; it's also imported copper ores, nickel ores, lead ores, zinc ores, and all these. I mean, refining is a dirty business. China doesn't mind doing it. We in the West don't want to muck up our hands with this. And that's actually, incidentally, one of the reasons why China has a virtual monopoly on rare earths, because rare earths also come out of this refining thing. I mean, aluminium or bauxite, I understand, is one source, if you like, of rare earths. And you require a lot of electricity to turn bauxite into aluminium. And who's got the electricity now? We haven't. We used to do it actually in Fort William, which is in Scotland, where we had hydroelectric power. I don't know if we do it anymore. I don't think we do. I think that's closed down. But can America do it? Well, they're at the moment powering loads and loads of computers to do AI or mine Bitcoin or whatever. So we just don't have the electrical capacity, if you like, to compete with the Chinese in these matters. So. Yeah, I think China realizes that it's got us firmly in its grasp. I mean,
short and curlies, yeah.
I won't use the rude word, if you like, but that's
I will.
It's squeezing and it's hurting.
One of the most misunderstood aspects of the current silver market is the role of volatility and margin adjustments. These are often interpreted as decisive interventions capable of halting price advances. In reality, they function more like temporary impediments designed to manage optics rather than resolve underlying imbalances. Short positions remain incentivized to mark prices lower during reporting periods, but that pressure does nothing to address the core issue: the market's inability to deliver physical silver at scale. What is unfolding is not primarily a futures exchange squeeze, but a physical liquidity crisis centered in London, where vaulted metal is largely ETF-owned and therefore unavailable for industrial withdrawal. This distinction is critical. Industrial users are no longer participating as passive consumers reacting to spot prices. They are entering forward markets explicitly to secure delivery, effectively converting paper exposure into physical ownership. That behavior drains liquidity from a system that was never designed to support sustained physical offtake. As a result, paper positions that appear balanced on exchanges mask a deeper stress in real-world availability. This sets the stage for the next phase of Macleod's analysis, where the relationship between paper pricing and physical settlement begins to fracture more visibly.
Is the paper market an accurate representation still of the physical price of silver?
It's the consequence of many years of demand exceeding supply. I mean, just look at the Silver Institute tables. They show for the last 5 or 6 years or whatever that there's been more silver demanded than supply. And the difference has always been made up by the category they call investment. Yeah, it's not investment. It's Chinese stocks, basically. I mean, the fascinating thing is that in 2023, China supplied silver to the West. I can't remember the exact figures, so please don't hold me to it. But I think we were looking at something like 300 million ounces being supplied to the West. Well, the fascinating thing is that the supply is actually to the UK, Singapore, and I can't remember, there's another one. I mean, basically it was going into financial centers. And then in 2024, again, it was about 300 and something thousand ounces. Sorry, 300 million ounces. I'm talking millions of ounces. And that went to what I would call more industrial countries. So you could see that what was happening is that it was getting vaulted in places like Singapore, London, Switzerland, wherever, where the vaults are in 2023. But in 2024, it was definitely being drawn down by industry. So, look, this is important to understand because this is why China is trying to restrict, if you like, the export of silver. I mean, there's no doubt about it. Silver, as far as China is concerned, the importance of silver is absolutely going off the charts. They cannot afford to lose stocks. So I think that's really why they've got this new licensing regime. It's not a question of China stopping all exports. No, not at all. But she wants to just really control them. So I think that's what's going to happen. As regards the price, the relationship between paper and physical, I mean, basically, industry is using, and remember, I haven't said that investors are doing this. They're not in it at all. But industry is basically using paper markets, derivatives, as a means of acquiring physical. I mean, on COMEX, something like 15,000 tons has been stood for delivery this year. Now, of that 15,000 tons, I guess the majority of it, the vast majority of it, would be industry using futures as a means of acquiring the physical. There is no nation on earth that produces as much as nearly 60% of mined silver, as it were. This is silver, if you like, coming out of the woodwork one way or the other. And it represents roughly 60% of annual mine output. This is just through COMEX. I don't know how much is going through London because we just don't have the figures. But this is the function now. This is the function of paper, and that is to turn paper into physical. And this is something which I think is going to really mean that we're getting towards the end of the paper markets as we know it. And there's virtually no speculative interest in this at all. I mean, if you look at the open interest on COMEX, that is low. It's around about 155,000 contracts, which is certainly not excessive and indicates that the speculators are just not there. So it's this is an interesting thing, and we have yet to see investors turning to silver in anything like the sort of quantity of numbers that you would expect of something which is, not only rising, but looks like, a reasonable play.
Is that what you gather when you look at the silver miners, which have pretty much just tracked the price of silver, where in different predicaments, they should outperform the price of silver?
I think that's actually, an interesting relationship, because if they were outperforming silver, that would confirm that investor interest is moving into the sector, but it's not. And there is, investors basically have gone nap on AI and things like that. They haven't bought into the mining sector at all, and they're actually missing the biggest market of all at the moment. Now, we know that gold is, if you like, discounting a certain amount of loss of purchasing power in the dollar in 2026. We can't measure it, but that's a logical, if you like, a deduction of what has really been happening between gold and the dollar. But nobody's really, looking at the prospects for the dollar. We get cuts in interest rates from the Fed, and they're talking about another cut, and they're talking about QE and all this reflationary stuff. Does anybody actually think that the purchasing power of the dollar is going to decline seriously in 2026? They don't. Put another way around, more conventionally, what do people expect inflation to do in 2026? They think it'll be subdued. They're wrong. They're horribly wrong. Gold is saying you're wrong.
As Macleod explains, the divergence between paper prices and physical availability is not the result of overt price controls, but the cumulative outcome of years in which demand persistently exceeded mine supply. Official statistics acknowledge this imbalance, yet the shortfall has routinely been attributed to so-called investment flows. In practice, much of that metal originated from Chinese stockpiles. What is now changing is the direction of flow. Silver, that once moved into Western financial centers for vaulting, is increasingly being absorbed by industrial users, particularly in sectors where substitution is not viable: photovoltaics, electronics, defense systems, and electrification infrastructure. Once silver enters these supply chains, it does not return to the market. This shift explains why China has moved to tighten control over silver exports without imposing outright bans. As the world's largest refiner and one of the largest miners, China occupies a uniquely strategic position. Its refining dominance is not limited to silver alone, but extends across base metals and rare earth byproducts that underpin modern manufacturing. While Western economies outsourced these environmentally intensive processes decades ago, China consolidated them, along with the energy capacity required to sustain them. That asymmetry now translates into pricing power, not through market announcements, but through control over marginal supply. Within this framework, paper markets are increasingly being repurposed. Rather than serving as venues for speculative price discovery, they are becoming conduits through which industry acquires physical metal. Delivery volumes through futures exchanges now represent a significant share of annual mine output, an outcome that would have been considered impossible under the traditional model of leveraged trading. At the same time, speculative participation remains muted. Open interest is subdued. Mining equities are merely tracking the metal rather than outperforming it, and retail investor enthusiasm is largely absent. This is not a crowded trade. It is a structurally tight market advancing without speculative fuel. The broader monetary implications are difficult to ignore. Gold has already begun discounting a decline in the purchasing power of the dollar, despite widespread confidence that inflation will remain contained. Bond yields are reinforcing the same message, demanding compensation for monetary debasement rather than growth. Silver, historically more volatile and more sensitive to supply constraints, tends to lag until these pressures become undeniable. When investor capital eventually recognizes what industrial buyers already understand, the repricing is unlikely to be gradual. Silver's current behavior suggests that its price is no longer anchored by conventional supply responses or paper leverage. Instead, it is increasingly governed by physical necessity within a global system facing energy constraints, geopolitical fragmentation, and monetary dilution. If that assessment is correct, then the market is not approaching a peak, but the early stages of a repricing process that reflects scarcity rather than speculation. Thank you for watching. If you found this analysis useful, please like the video, share it with others who follow the precious metals space, and subscribe for more in-depth discussions on markets, monetary policy, and the structural forces shaping the global financial system.